Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Dietrich, and I'm joined by my co-host, Sonu Varghese. Each week, we dive into the important market-moving events and cut through the noise to help you, as an investor, identify what really matters. Let's get this show started. Hey, everybody. Welcome to the 12th edition of Carson's Facts versus Feelings podcast with Ryan and Sonu. Sonu, this one's called Against the Grain. There are some well-known things we're seeing out there that we've maybe got a little bit of a different take. But before we go there, in the last week, if I'm correct, you've had two lunches with two really cool and famous people. First off, you and I got to have lunch last week in Ohio. You were in town for the Thanksgiving holiday. But who are you having lunch with today? If you want to talk about it, I'm impressed.
No, this is very exciting for me. I'm having lunch with Cliff Asness from AQR. So, one of the largest alternative, mostly liquid alternative, but even factor investing, all of that, right? Yeah. Cliff's one of the pioneers out there along with his partners. They're all University of Chicago PhDs who went into Goldman, started AQR about, in the 90s, late 90s. And yeah, they're massive. So it's very exciting. Yeah. And of course, having lunch with you was exciting in the middle of Ohio. What was the town?
Wilmington.
Wilmington.
I'm in Cincinnati. You're up in Dublin area, Columbus. And that was the little town we found halfway in the middle. We had some barbecue, but maybe I was more fun, but Cliff is probably going to be more interesting. So enjoy that. But
hey, you're fun too. So,
there we go. But
sure.
So last podcast we did have Jamie on, Jamie Hopkins. I ordered his book. My book's on delay. I can't even get the book. So hopefully that's a really good sign. And Jamie said they sold out on Amazon. So congrats to Jamie. If you guys didn't get to listen to it, listen to the last Facts versus Feelings podcast with Jamie, where he talked about how he's going to help people find their freedom. And he wrote this book with Ron Carson. It's excellent. Just check that out. But congrats, Jamie and Ron, because again, it's on delay, so you sold a bunch of them, guys. So that's awesome news. All right, against the grain, Sonu. Let's just dive into it this week. There are three things we want to talk about. First things first, the yield curve. The yield curve's telling us a recession is imminent. That's one thing we're going to dive in. Maybe we're not so sure there. The consumer is strapped. Credit card debt is soaring. Economy is in trouble. We're not so sure there either. Then the last thing we'll talk about, this is a bear market rally. Everyone calls this a bear market rally. It might be something a little bit more. Sonu, you're going to talk mostly on this one. I'll put the ball on the tee and let you hit it. The yield curve. The yield curve is inverted. Now, before we go there, I'll set this real easy. We'll keep this real simple, guys. What's the yield curve? It takes a look at yields on various durations of bonds, right? And you got short duration, long duration. If the yield curve inverts, my math is right, Sonu, 2-year, 10-year yield curve.
That's right.
When that's inverted, every time since World War II, we've had a recession eventually. Now, sometimes it takes a while. Mm-hmm. The yield to 210 inverted on, you cannot make this up, April 1st, April Fool's Day of this year. Now, we've had some other yield curves just recently invert as well. Believe me, this is a warning sign, absolutely. But Sonu, tell me a little bit about what you found when you dug into the yield curve and why we might not be headed straight to Armageddon and a recession like we're being told.
No, I think you put it nicely, right? What is the yield curve? It shows interest rates on U.S. Treasury bonds, right, across various maturities. Now, on the short end of the curve, so yields, these are shorter maturities, 1 year, 2 year, things like that. They typically go up and down depending on what investors expect the Federal Reserve to do over the next year or two, right? Mm-hmm. These are 1 year, 2 year rates, right? Now, on the long end of the curve, maturities of, say, 5 years or more, let's say 10 year, right? We're usually looking at the difference between the 10-year yield and the 1 year yield or 2 year yield, right? Long minus short, right? So these long-term yields typically tend to be higher than those on the short end. So if investors anticipate, say, higher growth, more inflation, they're going to say, oh, we want higher interest rates, right? So that spread, the difference between short and long-term yields, are positive usually. Now, extreme cases, we get what you talked about, inverted yield curves, right? Where short-term rates are higher than long-term rates. This doesn't really make if you think about it, if you're a long-term investor, you're facing more uncertainty and risk, right? But wait, you're settling for less compensation than short-term investors. So, and why does this happen, right? It's basically what's going on right now. The Fed is raising rates to get on top of inflation, right? And this year they've raised rates by 400 basis points, right? 4%, right? Whereas bond market investors are like, okay, wait a minute. We think the Fed will go too far and the economy will get into a recession. And so if you have a recession, you're going to have lower inflation. And so they think, okay, if you have lower inflation, long-term yields can be lower, right? And that's why you get that inverted yield curve. Now, as you said, prior to the last 10 recessions, the yield curve inverted every single time.
A timeout. When you say the yield curve, which one? Because there are various yield curves. The 110, the 210,
right.
which one do you mean?
Spread. So I think a common one, a good one to follow, you can use the 10-year minus the 1 year, because the 1 year, you can use 3-month or 2-year, all of that as well. Yep. The 1 year goes back we have a long history for that. So going back all the way to the 1950s. And so the difference between the 10-year and 1 year, when it turns negative, that's what I mean by, the yield curve inverted, right? Of course, the 10-year, 2-year difference went negative on, as he said, April 1st, right? I can't believe that. But the 10-year, 1 year turned negative in, I believe, July of this year. So again, which is why they say the bond market investors are the smartest guys in the room, right? We've heard that before. And everyone's looking at the yield curve and like, goodness, recession, right? This thing has predicted the last 10 recessions. There was one false positive. 1965 December, the 10-year minus 1 year, it went negative, but there was no recession, right? So, and that's why everyone's like, wait a minute, this critical recession indicator is flashing bright red, right? Now, if you look under the hood, right? 2019, the yield curve inverted, right? And then we did get a recession in 2020, right? But, did the yield curve really predict COVID, Ryan?
I'm going to say no. I mean, I remember that period. The economy was really strong in February of 2020. I don't think we had a recession coming the next month, but obviously it was right. Was it blind luck or not? I don't know. But hey, it is what it is. Yeah.
So I'd put an asterisk on that one,
Good
right?
point.
Like just put a little, put an asterisk on that one, right? When you say 10 out of 10, right? But also like the yield curve is really inverted. Like the 10-year minus 1 year is like 1.7%, 1.07% or something like that, right? But it doesn't really tell you, okay, when will a recession start? Usually the start time has gone from, anything from 7 months to 24 months, 2 years later, right? How long will the recession last, right? And so the duration of the recession, how deep it will be, right? Doesn't tell you anything about that. And then how wide, right? How widespread is it? Does it hit only 1 or 2 sectors of the economy, or does it hit everything altogether? Right. So I think that's what, yes, yield curve inverted. Yes, recession. But there's a lot of nuance behind this. And it really hasn't worked even in other countries. You take the UK and Canada, which I would say are the global economies most similar to the US and maybe Japan too. And you've had several yield curve inversions that were, false positives. Right. So overall, I think, if you think about long-term yields as some combination, it's basically what do investors expect yields to do, Federal Reserve policy to be in the long term, right? And that depends on inflation over the long term. And if you look at inflation expectations, short-term inflation expectations, because inflation's so high now, have surged. They're really high. We all know that. You and I have written about why we think that's going to come off the boil as well. But long-term inflation expectations are on the lower side.
Right.
And if you're expecting inflation to be lower, well, long-term yields are going to be lower. And I think that's basically why we have an inverted yield curve now.
Fascinating discussion. I think you just made all of us smarter. And in fact, I'm so smart. I don't know if you're going to see the video of this, but I've got these I
feel like I'm going against the grain, like, hey, let's look at some nuance here, right?
Yeah. But, what I was getting at was like, I don't know. I just got some headphones here. Like I've got them stretched as far as they go. They barely fit my head already. So I've got a big head, but I think you just made me a little smarter with what you said there. So listen, Sonu. So here's the deal. I mean, here's my take on it. It is something we are watching, but like you said, I mean, we've seen these inversions before, and you know what's happened? Stocks have gone up for like 30 more months. Okay, you've had years before a recession. Believe me, if you would say, "Hey, Sonu, Ryan, what are the odds of recession next 3 years?" That's probably pretty good, And now we got this inversion across the curve, and so we're not minimizing it. We're going to talk about the economy and stuff in the next discussion as we talk about against the grain. So we don't think there's a recession, but let's talk about the credit markets just for a little bit. I said the smartest guys in the room, probably the bond market. All right, yield curve, yes, flashing warning signs. But we look at the credit market, right? High yield spread, investment grade corporate spreads. They're not blowing out. Keep this real simple. They're not blowing out like we've seen before previous
Ryan, do you want to give a quick thing on what exactly you're talking about when you talk spreads? Credit spreads?
No, I'm not smart enough. How about you do it?
Like if we're talking about with the yield curve, you're talking about treasuries, right? And you
Mhm.
don't expect the U.S. government to default,
Right.
right? But if you're lending money to a company, maybe you lend it to a company like Apple and think, oh, that's good credit, but
Mhm.
maybe not as good as the U.S. government.
Yep.
Or if you take, several other companies which are nowhere as good as Apple, right? If you're lending money to them, and you think, okay, wait, if I'm charging the government 4% interest for giving the money over 10 years, I'm going to charge Johnson and Johnson 4.5%, right? So there's a difference there, and that difference is the spread when you talk about credit spreads.
Knew you could do it better than I could. So but the easiest way to put it
Right.
again is, the riskiest stuff is high yield, right? Quote unquote, the riskiest stuff. And again, we saw massive blowouts in those spreads back in 2015, 2016, because a lot of energy companies, which were some of the riskier plays at that time, were having under a lot of pressure. So again, this is a messy crystal ball, believe us. But again, the credit spreads are not showing similar signs of worry that we've seen before previous recessions. And that's just something to think about. So, Sonu, we need to wrap this up and move forward. Anything else on the yield curve that you want to point out before we move forward?
I think it's a good indicator, and 10 out of 10 is good, but there are asterisks all over the place. Yep. We gave you one, which is 2019.
Yeah, and I also love the point you pointed out. Various other countries, have had yield curve inversions that did not signal coming recession. So, and at the same time, I traded options for 11 years, and everyone's thinking like somebody isn't thinking. General Patton. Everybody's talking about the yield curve now, and kind of makes me wonder if maybe there's some other things we should be looking at. But Sonu, last week was Thanksgiving. Let's change gears and get a little personal. How much did you eat at the in-laws' house up in Dublin, Ohio? Did you guys have a good time?
That's too much. And I did get out of Ohio before Saturday. And, you being from Ohio, you probably know what I'm talking about.
Yeah.
So we won't touch that subject about what happened last Saturday.
Something about college football. We'll just stop there. Yeah, it was not a.
But
not,
no,
not
it was. It's always nice when the kids get together with their grandparents. There's something special about that.
Yeah, absolutely. Yeah, I saw my family, and then went to Emily's family, my wife's family, and we ate the standard stuff. It was very, very tasty though. So hopefully everybody out there had a great Thanksgiving. So something else against the grain, right? We just talked about the yield curve, the consumer. So no, I'm hearing the consumer is strapped. I'm hearing the headlines that 15% year-over-year credit card debt has just increased. That data according to the Fed. Some of the nearly $1 trillion of credit card debt, like the highest level ever, right about pre-COVID levels, again using data from the Fed on this one. Wow. We're being told that we're in trouble with the economy because the consumer is so strapped. You did a great job looking at this on a recent blog post. Maybe the consumer's not so strapped as we go against the grain. Tell me about it.
Right. Let's talk about credit card balances, right? You see these it's on. I look everywhere and it's like, credit card balances are rising, right? And that's true. Of course, it's rising because we are all paying more for stuff, right? You and I had barbecue in the middle of Ohio. It wasn't as expensive as barbecue again in Chicago, but it's more expensive, right? Than it would have been a year ago, right? Because everything's more expensive, so we're spending more, and people are spending more even on even after adjusting for prices, right? It's just buying more stuff, right? And so you would, of course, credit card balances are increasing. But you have to look at the other side of that, right? How much all of us or households are paying to service that debt? How much interest are they paying, right? And if you look at it, debt service basically as a percent of disposable income, and this is across the aggregate overall economy, right? Debt service payments are less than 10% of disposable income, right?
Right.
It's up from a record low of about 8.5%, but that's pretty much where we were before the pandemic. And before the 2008 and 2001 recessions, it was much higher than that. So consumers are definitely taking on more stress prior to those two recessions, and we are nowhere close to that right now.
Let me jump in just for a second, Sonu, on that, because I love that. I think it's as simple as people are worth more, right? You're spending some, but you're worth more. And if you look at the percent of what people are spending on energy, right, like gas and oil and things like that, fill up your car, it is, I think it's like 4 or 5% right now. It was like double digits right in the early 80s. So again, yes, all the crude's actually, by the way, crude just went negative year over year just yesterday. Who in the world would have seen that coming? I mean, but nonetheless,
what's that going to do for inflation?
Yeah, how about that? And I saw like chicken breasts are down like 70%. Chicken wings are down a lot. So anyway, we'll get into that in the economy discussion here. But believe me, inflation's coming back. So anyway, bottom line, though, is people think, oh, I'm paying all this for gas. And believe me, we are. When you go to the pump, you're paying more. But the truth, again, is there's other things that are much lower, and you're really, as a whole part of the pie, people are actually worth a lot more money, even though the stock market's down and bond market's down. Don't get me wrong. We're feeling it just like everybody else. As a percent of what they're doing, it's not as high as you might think. So that's a great point. What else did you find? Mm-hmm.
I think that's what you brought up is so important, right? People are worth more. And two things there, right? One is, and net worth comes from two places, right? How much you're earning and how much you're saving, your savings, right? So in terms of how much people are earning, that's growing pretty, if you look at overall income in the economy, that income is going to turn into spending, right? Some of it will be saved, but it turns into spending, right? So if income growth is high, you think, okay, spending is going to be high. And income growth right now is running about 8% year over year, right? Total income earned across all workers in the economy, right? And that's because employment is high, and the amount of earnings people earn per hour, that's also high, right? Now, the other side of this is the Fed looks at it and say, oh, this is what's driving inflation, and we need to hike rates so that 8% goes down to, say, about 5%, right? But even 5% is not that bad. That's what we had before the pandemic, and
right.
That was, you said it before, that's a pretty good economy right there, right? And then you have excess savings, right? So households saved about $2.3 trillion across the entire economy over the pandemic, right? This is because of stimulus checks, expanded unemployment benefits, and a lot of people just didn't spend money during the pandemic, right? So they had a lot of excess savings. Now, over the last year, we've had a lot of inflation, so households have started to pull out money from that pot, about $800 billion or so. But it's not empty, right? And we just talked about gas prices. As gas prices go down, think about it, that's like a tax cut, right?
Right.
So two things which related to excess savings. One, it's not empty. And if inflation eases, which we know it's already kind of happening, that means excess savings are going to fall at a slower rate as people don't have to dip into their savings to fund consumption anymore. They just do it out of their income.
Yeah, no, great points. I'm trying to find the numbers. I know I wrote it down. Here we go. Here's some data on the consumer. Black Friday, according to Adobe Analytics, $9.12 billion spent online on Black Friday. And then Cyber Monday, $11.3 billion. That's up about 5.8% year over year. That's an all-time record. Both those are all-time records for spending. I don't know. Again, the consumer might be having some trouble, but maybe not as much as what the media is making it sound like. And believe me, I don't know. I don't think you mentioned this, Sonu, but I believe if you look at credit card debt to how much someone's credit is, their credit card debt is only like 21% right now, and it was 24%. The average before the pandemic, right? So yes, balances are all time high, but again, relative to how much a consumer could put on a credit card, it's not even above pre-pandemic levels, right?
No, exactly. Credit utilization is low.
There's the word I was looking for. That's dictionary.com word of the day, utilization. I would never come up with that in 1,000 years, but that's what I meant to say. Yeah.
But even home equity loans, right? People haven't tapped their home equity loans to the extent because home prices are higher. I mean, yes, they're starting to go down a little bit, but they've gone up so much over the last couple of years, right? I mean, you just bought a home,
Yeah.
And there's a lot of home equity loans that haven't been tapped. I'm not saying, like, people tapping into that is a good sign, but so far there's still a lot of credit capacity left. All this to say the consumer is not that stressed as we saw, in the last couple of cycles.
No, excellent points again. So believe me, again, worries, yes, and so we didn't talk too much about this. Sometimes people say, well, but look at the breakdown of wealth, right? It is people that are still struggling, lower incomes that are maxing, quote unquote, maxing out their credit cards relative to wealthier people who aren't. I've seen data, honest to goodness, go both ways on this. I mean, believe me, the biggest jumps in incomes the last 2 years since pandemic are lower incomes,
Absolutely.
right? I think that's a great part.
Absolutely.
Believe me, the pandemic was terrible, but one of the positive impacts is we're finally seeing some real significant wage growth for lower income brackets. What's your take on that argument that I hear quite often?
That's absolutely, you nailed it, right? You absolutely nailed it. The lower income, and we look at, officially we can look at this by looking at income growth for what they call non-managerial employees, right? People who are not managers, so production and non-supervisory workers, right?
Yeah.
And wage growth for that group has been much higher, and there's been a lot of turnover because people have quit jobs for better paying jobs. And the other side, as we mentioned, is inflation, right? lower income people tend to spend more of their income on gas and food, right, relative to higher income households. And look, if gas prices go from $5 to $3.50, that's a big break.
Yeah. No.
Right. That's, as I said, that's like a tax cut.
Yeah.
Good, it was like point. A tax increase earlier this year, but now we're going the other way. I think that's going to be huge.
That will be. And by the way, speaking of energy, so crude oil went negative year over year. Fascinating because the energy sector is up like 60%. So we won't really dive in on there. Maybe it's a future podcast, but I don't even know. Wrap your head around that one. So any other, let's see here. Anything else on the consumer? Oh, I know what I was going to say. When I took a look, Sonu, at the last 13 recessions, not a single one of them started in a pre-election year. Now, guys, that'd be next year, pre-election year. Now, I am fully aware, right? Get the asterisks out there. January 1970 and January 2008. You could say they started a month after the pre-election year. So this isn't perfect. But again, and why is that? Believe me, you can talk to 10 people, get 10 answers. I think it could be almost as simple as there's an election coming up. The government can pull some certain levers to kind of get things going. They want the stock market up. We'll talk about the stock market next. You get the economy okay, get inflation coming back down like we've talked a lot about. We think inflation's likely peaked. It's going to come back down like an anchor potentially next year. But again, it is what it is, right? There's been no recession that started in a pre-election year. Last 13 times. That's like back to World War II. We don't think there'll be a recession next year. That's our base case. Believe me, we could be wrong. We could have a recession. If we do, we think it'd be a mild recession. Sonu, why do you think that is? The last 13, is it random or not? Why is the last 13 recessions, none of them have started in a pre-election year?
That's fascinating. So I'm going to try. I was thinking about this because I saw that chart and I was like, why would that be? I mean, beyond the fact, okay, it could be random.
Could be random.
But set that aside, right? But putting what you've put out there about midterms, right? A lot of midterms, the party in power loses. The president's party loses, right? And then you get gridlock. So I wonder if gridlock in that, pre-election year turns out to be a positive in some sense or the other, right? There's not a lot of policy movement, to the upside or downside, one way or the other, right? Right. So because there's gridlock, I wonder if it's like, okay, there's less uncertainty about what will happen in DC, and so there's less, worry about things going, to a large extent in any direction. And maybe that's why. I don't know.
Yeah, no, good points. I mean, we're gonna have, I guess we'll see. Maybe 50-50 Senate. Maybe it's a little bit more. But you look at the House, right? The Republicans have like a 4 or 5 seat majority. We don't know the final numbers yet, I know. But you're talking about as gridlock can get when you look at the breakdown of that. But
and the only thing that will happen, hopefully this will happen. But yeah, it always happens. They'll fund government, and that's about it.
Yeah, well, yeah, there'll be some of those types of deals that go on. But anyway, so great discussion there. As we go against the grain, some of the things that are out there. We've talked about the yield curve. We've talked about the consumer being strapped. The final thing is the talk that this is a bear market rally. Everywhere I look, Sonu, I hear this is just a bear market rally. I guess the question is, it might be, right? My definition of a bear market rally is when stocks bounce a little bit and then they come back down. 17% rally last summer, then stocks made new lows in October. I don't think it's so simple. We're on record as saying we think the lows were made in October. We've talked a lot about that. One of the main reasons I'm pretty optimistic, I'm seeing a lot more market breadth, right? We had energy leading for a long time. Now we've got like healthcare, we've got financials, we've got industrials, staples are doing pretty well. You've got different groups that are actually participating in this rally, and I like that. But one more stat, Sonu, then I'm going to go to you. When you look at midterm years, I think it's safe to say we're probably going to be negative this year on the S&P. We're down ballpark 15%, although we think there can be Santa Claus come to town still, so a little bit more upside before the year's over. The last 8 times you were down in the midterm year, that following year, the pre-election year, was higher every single time, 8 for 8, up about 24.6% on average. You look at the last 5 times this happened, the last 50 years, the worst return the next year was 26%. Trust me. Every time is different. There's lots of scenarios out there, but a lot of those midterm years, bad stuff was happening. All right, 62 and 82 weren't really great years for some things, but then the economy turned around and went higher, and then the stock market did well. It is what it is. Pre-election years, Sonu, are really good. You think that could happen next year in 2023?
Well, certainly hoping so, but that positive seasonality is something else. I mean, even you break it down, right? Next 6 weeks. Thanksgiving through year end.
Yeah.
I think I saw some charts from you that like, oh, there's positive seasonality there.
Mhm.
And then looking beyond that over the next 1 year, 2023, it's striking. Yeah. Like not a single time has it been negative when the midterm year was negative.
Yeah, I mean, and then we've talked before on this very podcast, but 1 year off the midterm year lows, and no one knows when the midterm year lows are officially until it's over. I get it. Probably October 12th, in our opinion, though. 1 year off those lows, the S&P is up 32% on average, again, going back to World War II. So just some different things out there. But, I mean, let's talk about earnings for a minute, because earnings matter. And I'm seeing a lot of news out there that earnings estimates are coming down. I mean, I don't think you can argue with this. They are, right? I think earnings this year are expected to be up maybe 4 or 5% when all is said and done. We are looking for potentially, you and I were talking on this very podcast not that long ago, maybe we could hit double-digit earnings growth. But we have hit a little bit of a snag the last quarter or so with earnings growth. What are you seeing out there, Sonu?
See, even here, I would separate it, right? Like, because we're talking about, when you're talking about earnings, we're talking about the S&P 500. These are some of the largest companies in the world. 40% of them, I think, is it 40%, Ryan, that make their money outside the U.S.?
Yeah, it's approximately there, but that's correct. Yeah.
Right. So if the rest of the world is struggling, and that, absolutely, right? You look at Europe, you look at Japan, you look at Asia, goodness, you look at China, right? Second largest economy in the world, and everything happening there. Of course, you think revenues and profits would be down outside the US, right? And I think that's a large reason why these expectations have fallen. I mean, there's no real clear, I keep looking for this. I've talked to multiple folks about this as well. Like, can we separate it somehow? Like, how much revenue, how much earnings is coming from outside versus within the US, right? So there's no real good data for that, because every company, reports things a different way, right? Understandably so. And maybe they don't want to report things, they want to conflate some of this stuff anyway. If the US covers for poor performance outside, right? In their view, that's a good thing. But for our purpose, I'm like, wait a minute, when you think, okay, earnings revision estimates are going down, all of that, I think you have to separate it. What's happening in the U.S. versus what's happening outside the world.
Great point. We've talked also
outside the U.S., not outside the world. Goodness.
Oh,
I said outside.
Yeah, my goodness. Wonder what is happening outside the world. It's crazy enough here. I don't know.
Maybe Elon Musk can figure out how to get earnings, in Mars or something. But,
He's got his hands full right now, but we'll just leave it at that.
Yes,
so anyway, you think about it. So the U.S. dollar is having one of its strongest years ever. Now it's come back significantly over the past, we'll say 2 or 3 weeks. But still, the U.S. dollar is a headwind, right, for these multinational companies selling overseas, bringing profits back. I think a lot of it is, hey, I don't know too many people out there saying they expected a 15% rally in the U.S. dollar. Just so you guys know, that's a huge move for a currency. Usually currencies don't move that much. But again, times of uncertainty, people flock to the safety of the dollar. We do have the world's reserve currency. It is what it is. We've seen that this year. But I think one of the potential tailwinds next year, Sonu, could be, whereas a headwind of maybe the dollar jump this year might have cut 4 or 5% off earnings. We don't really know the official number. I believe we're all kind of guessing at this, but it probably did. If you get the dollar pulling back maybe 10% next year, which we think can happen if inflation peaks, the Fed becomes a little more dovish, now you're talking 3, 4, 5% tailwind to earnings. Earnings are supposed to grow about 5% according to FactSet estimates next year. Maybe that could be the surprise next year that can help if the dollar is weak. And I hate to say, is it that simple? But I look at charts. When the dollar goes up, usually stocks don't do well. Dollar goes down, stocks do well. Sonu, is it that simple? If dollar starts to weaken, that can be a tailwind?
Yeah, as long as I'm concerned, as long as it doesn't, as long as it's no longer even a headwind, right?
Yeah.
Forget it being a tailwind and falling. Just stop going up, right?
Good point.
I think that itself will be big. And we could get there, because if you think about why does a currency go up, at least to a first approximation, like, wait a minute, if interest rates over here are much higher than what they are in Europe, people are like, wait, I can get more for my money in the US, so I'm going to buy US dollars, right? And then the currency tends to go up. That's very simplistic, but think about it in that sense, right? Now, why are interest rates going up? Because the Fed is raising rates, right? In Europe, they are raising rates, but they're probably in the middle of a recession, so there's only so far they can go. So that difference between European interest rates and US interest rates, really the rest of the world, is large, right? But once the Fed stops raising rates, forget even pivoting to and cutting rates, right? Once they pause, that's it, right? Though that spread, that difference between interest rates, which is ironically where we started this whole podcast run, that difference between US and foreign interest rates stops going higher. And I think that will be when the dollar stops going up.
Yeah, very interesting. A perfect circle, right? Started talking about one thing and we ended up back there. We didn't plan on that, but that's how it works. One final thing that I love, again, looking at market sentiment, and one of the potential reasons that we've had this big rally off the October 12 lows, the sentiment got so low, right? Historically low across the board. We talked about it week after week saying, listen, there's a lot of kindling here. We just need a match. The match was inflation. The CPI numbers are starting to come down. We're starting to see the positives there. The recent Bank of America Global Fund Manager survey came out, and they, according to Bank of America's data, that 77% of the people surveyed saw a global recession next year. Over the next 12 months, I should say. That's pretty consensus to see a recession. Also, where was it? It was investor risk appetite is the lowest ever, according to this. So this data goes back multi-decades. You're talking the lowest risk appetite, for investors ever. And nearly, 4 out of 5 of them are expecting a global recession. A lot of bad stuff is priced in. If we can get some better news, and we think we can, if the dollar peaks, inflation starts to calm down, yields start to calm down a little bit. Yields might go a little higher, but just stop going up as much as they are. So much bad stuff's priced in. Don't forget 1962, right? We're on the brink of a nuclear war. All right, you're in a new president. You had midterm year. You had uncertainty, an economy kind of shaky. And then there was a massive, massive rally, late 62, 63, 64. I mean, John F. Kennedy was tragically assassinated, okay? And then what happened? The market still went up another 15, 20% the next 6 months. It was in the midst of that bull market. So when things get really bad.
That was the time when the yield curve inverted, 1965, and there was no recession after that.
Wow. Maybe we need to start talking more about this. Are we back in the 60s?
Of the mid-60s.
Yeah, how about that? So anyway, so believe me, there's lots of things we're seeing out there. But again, we call this against the grain, right? We've talked about the yield curve. We've talked about the consumer. We've talked about the stock market. There are some things that's not globally, but universally agreed upon, it feels like, at least from the media and a lot of investors' points of views. But hopefully we've kind of enlightened some people and shown that maybe it's not so obvious. So Sonu, last thing on this one, or last thing period, I guess. I spent a good chunk this weekend putting up some Christmas lights, some holiday lights. Do you doing anything like that? Yeah.
Yeah, I was going to ask if you're do you enjoy like this season? All of us get time off and stuff like that, but this general season, Thanksgiving all the way through the new year, really. Are you a holiday kind of a person?
Man,
sounds like with the lights and all that.
Don't make me sound like a Grinch. I love putting up my lights. I mean, there's some stress to it. I'll tell you what I'm looking forward to. So we used to live down in South Carolina, and driving back to Ohio for the holidays with kids and dogs, and that was stressful. But now we're in one spot, so I think it should be a little less stressful. But I do like it. I do enjoy putting up my Christmas lights, and I spent a lot of time this weekend putting them up outside, and all of them worked. You never know. You plug them in, you're like, oh, it doesn't work. But I did go to Lowe's and buy some new stuff. Not a recommendation of Lowe's. I just like Lowe's. Like walking around. So it makes me feel like I know what I'm doing, because I'm not very handy. I did use a screwdriver this morning. I slept at Holiday Inn Express last night also. But I did use a screwdriver this morning, so that was pretty impressive. Although I had to ask my wife where the screwdriver was, but that's because she uses it more than I do. But I still can use a screwdriver. Anyway, I don't know if you even answered me or not. Do you put up some lights? What do you guys do?
So this is the second year since we bought our home, and it's the first time I've actually owned myself. I mean, my wife owned before. I didn't, my name was not on the contract, so I never thought of myself as owning. So even though it was still joint, right? But this is the first time, second winter really, that we've had a place like a front yard more than anything else, and so it's on my list of things to do, getting lights. And it's just that since I've never done it before, I'm like, oh, I need to find out where do I plug it in? Right? Things like that. But I love the season in a sense. I love the lights. And, if any of your listeners are familiar with Chicago, Ryan, I know you are, but, Michigan Avenue is full of lights, and it's so great to hang around there during the season.
Well, I've said before, there's 3 things that scare me. I tell my kids this. I don't like sharks. I don't like my wife when she's mad at me. I should say, I'm scared of my wife when she's mad at me. And electricity. Electricity just confuses me. I plug something in, it doesn't work. It works. I blow a fuse. It rains. I don't know. Anyway, but nonetheless, my lights are working as of now. So, all right, Sonu, that was an awesome discussion. Everybody out there, thank you so much for listening to the 12th episode of Carson's Facts versus Feelings podcast with Ryan and Sonu. We're going to keep doing it if you guys keep listening to them. So everybody have a great, wow, December is right around the corner. Maybe you're listening to this in December. So holiday season is upon us. We think the bull market might have a little bit more upside and the economy is looking better. So we'll see everybody very soon. Take care. Bye-bye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Dietrich are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.